everybody wants to see the company successful. But why is it that often investors, founders, managers, and employees are in fierce conflicts with each other, working in different directions, stepping on each other's toes, and almost it seems like as if the commercial organization is set up against itself? Every of those four groups wants to see the company succeed. The investors want to see returns. They want to potentially see an exit. They want to push the company to the next funding round. The founders, they want to, of course, ideally also see an exit or an IPO. They want to cash out at some point, but also they have an emotional investment in this, a legacy investment. In some cases, they might just want to run a company for as long as possible because it is part of their identity and part of their purpose. And then you have the managers. The managers are typically not so much concerned with the investor discussions or like the long end game. They are more concerned about how do we make this company successful in terms of our position in the market? How do we make this company successful internally? How do we bring people to high performance? How do we adjust our go-to-market strategy? And then you have the employees, right? The individual contributors, but also the mid-level manager level, which often is more concerned about job security. It would be very nice if you could cash out from the shares that you were offered in return for lowering your salary. But apart from this, it's more about keeping the job, being part of a success story, ideally, which is also great for the resume. And if it's possible, have a big payday because you're working with a winning company. Now, while everybody wants to see the company successful, these four groups go about it very differently in very different ways. And this is where the clashes are happening. And this is why often from a perspective of an employee or of a manager, sometimes things don't really make sense. They seem irrational, especially when it comes to the founders and investors level. And there's often also not much explanation except for just do it and keep going and you will see. And what is it that they will see? For a lot of director level, VP level managers, it takes a while to really get or wrap their mind around how sometimes VCs, venture capital, and other investors incentivize or basically what they want to see in a company compared to what they as operational and strategic managers actually see as the priority of the company, like driving certain numbers like net revenue retention, driving the market position and so forth, where it's just professional work to get the company in the best possible position and optimizing it and so forth. This can sometimes conflict with investors asking for very different metrics. For example, steep month-over-month growth, top-line growth. Make sure that you get press releases, make sure that you are on the AI wave and that you have at least an AI project running somewhere, even if it conflicts with the existing product roadmap. And so there's often a lot of confusion and there's a big gap between these two worlds. And the founders are typically caught in the middle. The founders are typically caught in the middle if they do not have a strong backbone in terms of knowing what they want. It can often happen, and it does happen often, that then investors start pushing on the one side and managers push on the other side, and the founders are basically sandwiched in between. Founders live under a lot of stress in these setups. If investors are already involved, if there's a board involved, there's a constant pressure that they could be replaced. The investors might say, "You're brilliant, we love what you're doing, you have a great personality, but why not bring in a professional CEO? Why not bring in a professional COO or CTO, depending also on the co-founder's role, to accelerate things further?" And of course, if this is your purpose, if this is your legacy, you might be very wary of this, and you want to make sure that you have actually control of steering the company and being in charge. Now, sometimes it can lead to a point where founders feel like passengers on a train when they're in their own company, because now more and more people get involved, especially if more and more investors get involved. And it really becomes a battle of maintaining autonomy versus also increasing the valuation and, of course, going for a desirable financial outcome in the mid and long term. Now, it's important to understand that for VCs, for venture capital, especially in 2020 and 2021, there was a very clear calculation that 9 out of 10 startups in the portfolio could fail, and that would be acceptable as long as there's one company that makes a breakthrough and one company that just reaches a very high valuation, and that would make up for all the losers in the portfolio. And how do you get to high valuations, especially in a bubble or in a gold rush area like 2020 and 2021? Show growth month over month. Show that you can grow fast, that you can get market share, that you can get the word out there, and that you can acquire customers or users in some cases even only. Net revenue retention, profit margin, and so forth. Care about this later. This can be brilliant as a tactic. And it is also part of the playbook of growing a company. But the question is it a time-bound tactic that is being done intentional, or does it become an end in itself? Does it become the strategy to be unprofitable, to just grow at all costs without any regard for anything? Now, for some company that works out really well. They at certain scale they achieve a lot of compounding positive effects of this, and no, it works out for them at a certain scale. They push out another competitor by intimidating them with all the hype, all the press releases, and so forth, and build a moat technologically and so forth. And with the investor capital, they position themselves so strong that they basically take a dominant market position, and then they figure out margins and so forth. This is absolutely fine. But for most companies, that equation doesn't work out. And if you think about the 9 of 10 startups that actually fail, it is often that they maybe should not have taken the VC path or the VC medicine in the sense, because their path probably would have been more successful if they would have built more for the mid and long term, if they would have held off capital for the time being and actually built a very solid foundation. Because every time you scale, you also scale any chaos and dysfunctions that you're having. Like, you're not just scaling your success. And a lot of companies actually failed by scaling because they were pushed by investors to show steep growth rates. And then, of course, what do you do to get steep growth rates? You invest heavily in marketing and sales. What does this mean? Your cost of customer acquisition go through the roof. You do not focus much on what happens after the sale because you have to show top line growth. So that means now all the customers that you acquire, you don't have a follow-up product for them, you don't renew them, you don't retain them. They just disappear. It's a one-off transaction. And so it means that you have no real lifetime value either. So lifetime value meaning you over the span that a customer spends with your company, you sell them multiple products, and of course, the more revenue you get on average a customer, the better. So your cost of customer acquisition goes out of control, your LTV, your lifetime value goes nowhere, and you will end up in a situation where, on top of this, with your cost of goods sold, whatever it costs to deliver your service, you will basically make a loss at every single customer. And especially if you scale, if you show these growth month over month and growth at all cost that the investors want to see, you end up in a situation where you can smash all the sales records and the investors are very happy, but you might have a run rate of 3 more months, and then you won't be able to pay the salaries because you can actually not retain any of the money. And that's a tension that exists between the founders and the investors, and then you take it a notch down to the managers who then look at all of this and are being told, don't worry about any of the financial situations, just keep pushing, keep growing, something good will come out of it. Prioritize sales, prioritize marketing. Now the managers do what they're being told. They also want to keep their jobs. Some of them understand the logic, the growth at all cost logic, but ultimately, they will get to a point where decisions seem increasingly irrational. Why is there another press release? Why is the product team now hijacked to actually do a flashy AI project that has zero business purpose, zero business justification? And it means that the product team is not working on the actual needs that our customers have, or that the market actually requires in order to stay on top of the competition. So managers now start seeing decisions that seem to erode the very business foundations, that seem to be irrational and can't understand why this is happening. And then you typically see very heated executive meetings And if you're lucky, they're heated, because in many cases you also see the polite silence, where people just nod along. You see managers that know that things are running against the wall, but they will not speak up, because speaking up also carries career risks, right? And who wants to question the brilliant vision of the founder when the founder says, push for more growth month over month, we will get the next funding round, good things will happen. Who wants to be the person who stands up and says, I think we have a huge risk here. I don't know if anybody has looked at our costs. And that person then, of course, might be shut down as the pessimist, or as the divergent, the center who basically gets excluded from executives and meetings from now on, because it spoils the mood. And again, the founder might have a point in growing now really hard, and then getting a funding round leads to good things. But often it is not really well explained why, and often it is a gamble anyway. It happens too often also that founders get under this pressure of growth and showing certain metrics to the investors, just for the investors to pull out last minute, or getting cold feet, or doing a bit more due diligence and then stepping away from the deal. And the company then is left in a constant limbo. And while they are waiting, and while nothing is really moving, money bleeds and bleeds and bleeds, and the company actually erodes its own foundations. And employees look at all of this, and most of the time in startups don't understand the world anymore. A lot of them join, of course, because they want to work in a purpose-driven environment. They want to work in an environment that's fast and flat hierarchies, which often in practice is never the case, really. At the moment somebody has the power to fire you and the power to promote you and give you a salary raise, there's already a power dynamic. There's no flat hierarchy. A flat hierarchy means that you can talk to the boss over lunch. Of course, that's possible if a company is small. That would also be possible in a late stage company, as long as it is small and everybody sits in the same office. But so employees often get drawn in by these promises, just to find out that then they end up actually in the middle of all of this chaos, which is caused upstream by conflicts of interest between investors, founders, and managers. And it leads to a situation where the company always pushes towards ambitious goals, and I've seen this many times in practice. It's almost like a schizophrenia between going for the unicorn valuation in the morning and fearing bankruptcy in the afternoon. And it alternates between those two, and often it can lead to very volatile decision making too, where literally you have an announcement to push for sales and growth in the morning, and in the afternoon an announcement, we need to cut costs. We have to let go of 10 of our colleagues. So it's really important to understand what these dynamics are. And for founders, it really goes back to, what is the end game of this company? Too often it happens that if you had worked so hard to get your company to a certain level, to a certain amount of revenue, to a certain validation by the market, you want to keep that momentum. And now you have investors being interested. Maybe some of them become friends, some of them become advisors. And of course, you want to keep growing. You want to keep showing success. Finally, you have the opportunity to take it to the next level. But often it turns into just basically being pushed ahead of the investors, and being in a constant reactive mode in terms of investor expectations or advisor expectations. And you end up just constantly playing catch up with those expectations, being pushed into vanity metrics. And over time, this mindset of, we just are now being successful, we show this, and then something good will happen, and then we can think about exit options, and then we can think about what the end game is based on the opportunities that then we will then have. It often leads to a situation where the company just over time flattens out, and basically loses its fuel, which is its money. And while this entire tension that I just described is going on, top talent also leaves the company, and people just lose their patience at some point. So the remedy is really to have a sit down and to decide the end game. It might be an IPO. It's not realistic for most companies, but for those where it is, that might be a good option to work towards too. Once you decide that this is the path, the way of getting there, the operational and strategic decisions, go-to-market decisions are very different. It might be to be acquired by a strategic acquirer, some company in the industry or even outside of the industry that, for example, would buy the company for its customer database because they want to sell their product, like a complementary product, to the same customer group. It could be a private equity acquisition, for example, and typically the revenue stream needs to be transferable. Now I need to think about things like net retention revenue. I need to think very differently about what growth means, right? Maybe pumping money only in sales and marketing without keeping any of those customers is not the best approach in that scenario. It might be that the founders decide they just want to create a legacy business and they want to keep it for the next 20 to 30 years. It's the fulfillment of their purpose. And at some point they want to pass it on to a family member or to someone else. And they are not interested in selling at all. If that is the intent, then that also leads to very different strategic and operational decisions, and typically a great independence, of course, from the pressures of the day, contemporary pressures to just produce growth month over month over month with no regards for efficiency and margins and so forth. And in many cases, of course, it's better to have a lot of options open. The more options the company has, the better. And it might, even the founder who doesn't want to sell, still will have more options by building the company, by setting it up in a structurally sound manner than the investor who's chasing a month-over-month growth, which becomes a very fragile baseline, a very fragile foundation. And it makes the founder, creates actually almost a dependency, because now the business cannot stand on its own without more venture capital infusions, venture capital injections. And in that case, it creates a toxic dependency where the founder actually loses other exit doors, like acquisition. They might go for a strategic acquisition if they have something to offer. Like there are a lot of examples, like the acquisition of LinkedIn, the acquisition of WhatsApp, the acquisition of YouTube, even, where the company was not, these companies were not the best state-of-the-art businesses that were run, but they had a strategic position or technology or top talent that an acquirer wanted. So of course, this is always a route to go as well. But the most resilient route to go is to build a company from the get-go in such a manner that it could be transferred, it could be sold, even if there's no intention to do so. And that kind of prohibits just going for month-over-month growth in a gambling manner that could lead to the downfall of the company. It means that revenue streams are transferable. The company becomes transferable in the moment that you have certain rules, certain processes, systems running it, and the humans are there to amplify the effectiveness of those systems. And of course, those systems can constantly be re-engineered and iterated and evolved, whether that's the go-to-market processes, the marketing, sales, customer success, account management, and so forth, product roadmaps. It takes a clear strategic decision to make the company resilient and to make it sovereign and independent of the needs of the moment and of the hypes of the moment. And if more companies would have done this in 2020 and 2021, then of course they would be in a better position today. Many had to shut their doors because they were addicted to a certain way of running things. And then in 2022, the bridge rounds didn't come. That would solve for the growth at all costs, for the lack of margins, for the lack of profitability. These bridge rounds that were promised would not come because of inflation and because of the funding environment changing. And that is a risk, a systemic risk to the company that every responsible founder would have to, because knowing this, would want to defend against. And the way of doing this is creating strong business fundamentals and creating a company that can outlast any changes in the market, in the funding environment, and that keeps its eye very closely to the customers and the industry. And that doesn't mean going for customer reviews. It means to make sure that once money has been spent on marketing and sales, and those customers actually stay in the company, there's renewals, there's upselling, there's loyalty programs, and that the company basically creates cost-efficient revenue as it grows. And the more it scales, actually costs lower, and the more it scales, things become more efficient rather than chaotic.